Right now, the US national debt is over $35 trillion and growing by billions every single day. Some experts are warning it could crash the dollar, trigger inflation, and destroy your savings. But is that really true? And more importantly, will you become poorer because of it? The good news? You don't need to be an economist to understand this. The bad news? Ignoring it won't make it go away. The US government spends more money than it brings in each year. We call that a deficit. So it borrows to cover the gap. Like you might put something on a credit card and pay it off later, the government sells treasury bonds and bills to investors. When people buy treasuries, they're basically lending money to the government. Every year, the deficit adds to the national debt. Only years when revenues exceed spending, a surplus, would shrink the debt. In fact, over the past 90 years, the federal government has run 76 deficits and only 14 surpluses, meaning deficits are the norm. Put simply, deficits add to the debt, while surpluses subtract. So why is the debt exploding now? A big reason is that today's spending is much higher than tax receipts. Consider recent budgets, enormous pandemic relief bills, rising costs for Social Security and Medicare as the population ages, and more recently, higher interest rates on borrowed money, all boost spending. By contrast, tax revenues haven't kept pace. The Peterson Foundation notes a fundamental mismatch. Spending as a share of GDP is projected to rise faster than revenues. Key drivers are an aging population, more retirees, skyrocketing healthcare costs, and growing interest payments on the debt.
How does all this affect you? It may seem distant, but the debt can directly seep into your life in several ways. Inflation, interest rates, taxes, and even the value of the dollar. A recent analysis by Yale's Budget Lab, cited by the Peterson Foundation, warns that high debt puts upward pressure on inflation in both the short and long term. In plain terms, the more the government borrows and spends, the more it risks higher prices for everyday stuff. And remember, inflation is already a hot topic. Higher debt doesn't help. Tackling inflation often means raising interest rates, but higher rates sting borrowers. Credit cards cost more, car loans get pricier, and especially mortgages shoot up. The same Yale report quantifies this. A sustained rise in deficits, just 1% of GDP, could shrink household buying power by up to about $1,250 over 5 years, and raise an American family's annual mortgage costs by around $600 to $1,240. That means your rent or home loan could end up costing hundreds more each year. Higher debt also means bigger interest payments for the government, and those payments come out of the federal budget, money that could have gone to things like schools, roads, or paychecks. In fact, servicing the debt is becoming one of the fastest growing budget items. The Peterson Foundation notes that in the next 10 years, interest on the debt could total about $13.8 trillion, more than many major programs get. All that servicing costs crowds out other investments in the economy. In everyday terms, future tax dollars might increasingly go to pay off Wall Street instead of funding new jobs or education. Then there's the question of taxes and social programs. People often point out that much debt is owed to ourselves, i.e., government accounts like Social Security or the Federal Reserve. True, over $5 trillion of the debt is intra-governmental, but most of it is owed to outside investors, public or foreign, who demand interest. And if programs like Social Security and Medicare grow faster than their funding, we'll either need to cut benefits or raise taxes to keep them running. The trustees of Social Security already warn the trust fund could run dry around 2033 without changes. In short, today's debt might mean higher taxes or reduced services when you're working and raising a family.
What about the job market or wages? This is more indirect, but worth considering. If the government needs more of your tax dollars to pay interest or bail out programs, that can leave less stimulus for job creation or wage growth. Also, if high debt spooks investors who fund business loans, interest rates on loans might stay higher,
making it costlier for businesses to expand and hire. Bottom line, while the debt itself doesn't zip money straight out of your pocket today, its ripple effects can make life more expensive down the road. Think of it like a hidden expense in the national budget that eventually finds its way into inflation, loan rates, and tax bills affecting everyone's finances, including yours. Busting debt myths. It's easy to buy into simple truisms about the debt, but many are misleading. Let's tackle two big myths. The US can just print money and pay it off. On social media, you'll see people say, "We don't have to worry, the Fed can print more dollars." In reality, pouring more money into the economy without more output only drives prices up. As the St. Louis Fed warns, printing too much money would make each dollar worth less. Inflation. Sellers would hike prices to keep up, and you'd see serious economy-wrecking inflation, even hyperinflation like in historical cases. In other words, money printing is no magic fix. It's a recipe for skyrocketing inflation, and that erodes your savings. Debt doesn't matter because we owe it to ourselves. We have our own currency. We've heard this one too. We issue our own money, so why worry? Economists disagree. A Brookings Institution analysis points out that even US debt in dollars has consequences. Excessive borrowing can reduce national savings and drag down future income through higher interest costs. Right now, interest rates are unusually low, so debt seems cheap, but that can change. In fact, the Congressional Budget Office, CBO, projects that under current law, US debt could rise from about 78% of GDP today to over 150% of GDP by 2048, and interest payments would jump from approximately 1.8% of GDP to over 6%. Those rising interest costs could force painful tax hikes or cuts later. So telling yourself, "No worries, it's just dollars we owe each other," ignores the real burden of paying that debt back in currency that could be worth less.
Another myth? We'll just grow out of it. Sure, faster economic growth can help relative debt numbers, but it's not a free lunch. Given our aging population and long-term spending promises, even optimistic growth forecasts don't erase the gap. The government's debt analogy isn't to households. A country never really retires or stops rolling over its debt. Experts say the real goal is putting debt on a sustainable path, not eliminating it immediately. Bottom line, don't get lulled into thinking the debt crisis is someone else's problem, or that easy fixes exist. All the experts agree there's no simple way out. We have to manage spending and borrowing wisely. Protect your wallet. Smart moves in a debt-happy world. Okay, you might be thinking, so I'm stuck worrying about the economy? Thanks a lot. But it's not all doom and gloom. There are practical steps you can take to strengthen your own finances, no matter what happens in DC. Here are a few tips. Diversify your income. Don't rely on one paycheck. Consider side gigs or a part-time freelance hustle that plays to your skills or passions. Even a little extra cash adds up and gives you a cushion if one income source stumbles. Crowdfunding your own future beats depending on politicians for a bailout. Pay down high-interest debt. Credit cards and other consumer loans often charge rates much higher than 6%, far above what you'd pay on a treasury bond. If rates keep rising, the biggest drain on your budget could be those credit payments. Focus on eliminating expensive debts first. This frees up cash and shields you from rising rates. Build an emergency fund. Aim to save 3 to 6 months of living expenses in a safe, liquid account. If the economy hits a rough patch or inflation spikes, you'll thank yourself for having cash to fall back on. Yes, boring cash savings in a bank might not grow much, but it protects you from panicking sales or forced borrowing during a crisis. Invest wisely for the long term. While the national debt story unfolds, history suggests that broad-based investing, like low-cost index funds or retirement accounts, can still be a solid path. Stocks tend to outpace inflation over decades, so keep contributing to your 401k/IRA or other retirement plans. Diversify your portfolio, mix of stocks, bonds, etc. so you're not overexposed if one sector or the dollar itself dips. Stay informed and adaptable. Keep an eye on news about inflation, interest rates, and fiscal policy. If rates climb, consider locking in fixed-rate loans or refinancing. If tax laws change to shore up debt, adjust your budget or savings plan accordingly. Being proactive and flexible can make a big difference. These steps sound like good personal finance advice, because they are. By diversifying income, saving smart, and staying debt-aware, you'll be positioned better than most to weather whatever the debt situation brings. Take action and stay empowered. The US debt isn't something you can personally erase, but you can control how you prepare for it. Educating yourself on these issues is already a step in the right direction. Remember, financial decisions made today, by politicians and by you, shape our futures. If this topic matters to you, consider getting involved. Write your representatives, vote, or join citizen initiatives pushing for fiscal responsibility. And finally, don't lose hope. The goal here isn't to scare you into inaction. It's to underline why good money habits are more important than ever. As one expert quipped, debt can be a blessing or a curse. It all comes down to how wisely it's managed. By thinking ahead, and by hitting subscribe for more finance tips, you can turn what seems like a crisis into an opportunity to own your financial future.